The rupee has gone to 97, it went to 97, but then the rupee weakening means our imports get more expensive, our crude oil, which is where we're dependent a lot on, adds pressure to the rupee again because we have to keep importing crude.
It sounds as that you should take all your money out of India, put it in, I guess, Taiwan because they make the chips, Korea because they also make chips and memory, maybe China because they seem to have access to rare earths, and the US where all the innovation is happening apparently.
These feelings inspire me rather than depress me. They're taking the money out in hordes, and they have considerably changed their view on India because India does not have any AI. It's interesting that the median profit growth on Nifty 500 is like 17%.
That's quite high actually.
That's ridiculous. So it makes sense to invest into Indian markets during a period of pessimism, understanding that all of the stuff I talked about will take you another year. But over a 4-year period or 5-year period, you're probably going to see the benefits.
Are we all doomed? Or do the pessimists have a point? Hi everyone, and welcome to a new episode of the Capital Mind podcast. My name is Shrey Chandra, and I'm one of the co-founders here at Capital Mind. In today's episode, we're going to take a look at the concept of peak pessimism. Both Deepak and I feel that the narratives of India versus those of the rest of the world, particularly around the AI case, have diverged dramatically. India is the place where nothing can go right, and AI is the place where nothing can go wrong. With this, we thought we'd bring in Deepak to discuss, is this time really different? Is India doomed? What will prospects be going forward? Should you move some of your money abroad and invest through LRS or other means in global securities? And if India is going to do well, what should you invest in? So do listen in for a somewhat contrarian and different take. And if we're right, then do remember that he called this. If wrong, then don't let him forget it. With that, let's get started. Deepak, the narrative around India has been very negative for, I think, a very long time now. And I think in today's episode, we wanted to discover, have we reached peak pessimism and are things actually finally turning around? Or is it like, is the worst it's got so far? Now on that, I thought maybe we can start by actually fleshing out the bear case. So can you almost steelman or whatever, or flesh out, what is the most clear version of the negative scenario that you can lay out for us? Why is everyone so bearish on India right now, in your view?
So Shrey, I think the feeling or the narrative is bearish, and I don't disagree with the data points that are being put out. Now let's put the bear case right here. First bear case is the rupee has gone to 97. It went to 97 because of a bunch of factors. But then the rupee weakening means our imports get more expensive. Our crude oil, which is where we're dependent a lot on, adds pressure to the rupee again because we have to keep importing crude. Crude prices are going up because of the Hormuz war. India does not have domestic crude resources of meaningful sorts. India is importing gold like crazy. They did 72 billion of gold last year. Therefore, India doesn't produce any gold. Therefore, we have to bring in gold from outside. That's adding to pressure. Third one is that FPIs, foreign portfolio investors, are taking their money out. They're taking their money out in hordes. They've taken out, I think, more than 250,000 crores in the last 1.5 years or so. They have taken out more money than they've invested in perhaps the 2 years or 3 years before that. And they have considerably changed their view on India because India does not have any AI. In fact, whatever happened in AI is hurting our IT sector, which is our biggest export. It may take away a lot of IT jobs, which could hurt our economy. It could replace a lot of workers. So this is the bear case. It's like, oh yeah, AI comes, I will lose my jobs. There's an LPG shortage that's happening because India does not have enough LPG. Or that's what the narrative is, and it keeps flowing downward, saying, okay, foreigners prefer investing in other countries, not in India. India has adverse taxation for foreigners compared to everybody else. India has issues domestically, pollution, infrastructure, etc. India also has a relatively limited government space to spend. We do too much subsidies. We do too little actual, capex level investments. So therefore, a lot of our money, our taxes go towards paying for freebies rather than anything else. These are again macro, bear cases and all that stuff. And then there is, of course, the fact that even FDI, which was foreign VCs and investors investing into Indian startups, are now seeing those startups list and taking the money out. So it feels like there is a lot of underconfidence in India. Inflation will go up, you will hurt, you will basically, why then invest in India at all when you have all these headwinds in front of you? And then, therefore money is going out, markets are not going up, our rupee is going down, our FPIs are exiting, and so on.
Yeah, I mean, the way it sounds is that you should take all your money out of India, put it in, I guess, Taiwan because they make the chips, Korea because they also make chips and memory, maybe China because they seem to have access to rare earths, and the US where all the innovation is happening apparently. You've unfortunately made too strong a bear case. This is very compelling, and I don't think you've said anything wrong at any point. I mean, you have actually laid out what seem like facts. So, what am I missing, or what are we missing? Why are we recording this episode? Are we all doomed, or do the pessimists have a point?
So, Shay, my problem, I think perhaps I speak from a little bit of, too much gray hair, is that if I have seen these feelings before, these feelings inspire me rather than depress me. Because every other time in the past, and I say this as a generic, I'm saying, okay, yeah, you could say this time is different, but let's look at all the times in the past. And I've been in the markets, or I've at least tracked the markets for these particular times. I know it's happened even earlier, but take 2002 perhaps, or 2009, early 2009, 2013, a little bit of 2016.
2020
when the COVID crisis happened, 2022 when Ukraine happened as well. These are all mini issues at which India looked horrible. I'll give you an example. In 2002, there was 9/11 that had happened the year earlier. There was the Arthur Andersen and Enron scams, and a bunch of the massive IT bust had happened in the US, which apparently supposedly affected India. But at the end of 2002, it looked absolutely miserable for India. And interestingly, I think Bharti Airtel had gone IPO at just about that point into that bear market. And where were we? There was no meaningful telecom at that point, and so on. And then the markets went up 75% the next year. Because as it turns out, in the end of 2002, the actual underlying data was not as bad as the narrative. It looked like, India would get finished because, again, same IT bust. What will companies outsource to India? At that time, the IT companies were growing 30 to 40% per year. And of course, the dollar had,
was in a stable area.
It had gone up at that time, and India's inflation was relatively under control. So the narrative was negative. The markets were weak. Markets worldwide were weak. But India's fundamentals were not bad at all. Our IT industry was fledgling. It was early stages. I'm talking about a few billion a year versus the nearly 200 billion it does now. So in comparison, we were, we were very, very small. And yet that was the sectors that were supposed to drive the market, which perhaps that time was early banks and all that stuff, they all started to recover. And you could see that in the data. But the narrative remained very negative till end 2003. It was like we were going up during a market that was actually very, the news cycle was very bearish towards.
So they didn't believe the market. They were like, this is just a matter of time before it will crash. A dead cat bounce.
Yes, dead cat bounce. Okay. In 2009, we had this global economic crisis.
But even there, wasn't it was an American crisis, right? I mean, why was India impacted?
India was impacted a little bit downstream because we were very dependent on foreign flows. At that time, foreign flows, if FIs exited, and they exited about 80,000 crores at that time, which in comparison with today's 240,000 crores is a fairly large amount. And that just ruined the market because they were the majority of investors in the market. Domestic investment was very little. So in comparison, if you saw, mutual funds were very small in India at that time. There was no SIP, mutual fund at all as a thought process. So everything got wrecked, and a large amount of India's domestic market was speculation in the futures and options market, even more than what we see today and we complain about today. In comparison with the size that time, India was a much larger speculative player, domestic India. So you saw a lot of people getting hurt and going bankrupt during that time. And therefore, when the recovery started to happen after March of 2009, I remember the feeling because I had just moved to Delhi at that time, and I was like, this is not going to last. but this is a fake recovery.
So even you felt it
Even
this
I felt
time.
it. I was, and this is when it was really my maybe a second or third real crisis. There was a mid crisis in 2004 when the government, the left, came
Yeah.
into power. The market crashed like
I do
crazy.
remember that.
And then in 3 months it had recovered back because they said the left won't determine any policy, so the market kind of recovered. In 2006 there was a 30% fall after a large IPO, Reliance Petroleum, I think. They were a very big IPO, and then the market crashed 30%. But in 3 months, it was in April, and by June the market was down 30%. But by October it was back at new all-time highs. So I'd seen a few of these mini crises, but these mini crises were, at some point existential, saying, "Oh man, is everything going to go down in flames?" And then it comes back up relatively fast. So 2008 was more sustained. It was about 6 or 8 months. At that time, somebody told me, Deepak, these narratives will change very fast because news travels faster. So I didn't understand what he meant, but I think we've seen a lot of those crises after that. 2013, the 6 years of QE or 5 years of QE that America has done has flooded the US market and the world market with dollars and currency. People have money. India has a lot of money incoming from foreign investors. Again, even at this time, Indian domestic investments are like nothing in comparison with foreign investors. They were, I think, 22% of ownership of the Indian market by this time. 50% of India is promoters, 22% by FIIs, and the remaining by all of our retail investors plus corporates plus banks and all that put
This
together.
is today or this was back then?
This was 2013.
13, fine.
So that at that time, when there was a talk of a taper tantrum, that a taper meaning that no, I will not flood the market as much as I used to and reduce the amount that I flood the market with. This is what the US was saying. And then the emerging markets took a beating.
I remember this. It was actually quite horrifying because I remember our inflation was very high. The rupee weakened even worse perhaps than it did right now. It was quite alarming.
It was quite alarming because rupee went from 55 or 57 to 68. So that's about a nearly 20% fall in a matter of a few months. India then changed the interest rates to from overnight was about 7 or 8%. They made it 12% overnight. The 10-year bond went to 8 to 9%. Liquid funds lost money, which usually they don't do, right? So you saw this period of craziness at that time, and it was like, what's happening? I mean, the rupee is crashing, and then Subbarao had his terms came to an end. Raghuram Rajan came in. He created the FCNR, thing, and basically what he did was increase interest rates and also increase interest rates from a repo perspective, from a different standpoint. Instead of turning overnight rates to 12%, he made a slightly different change in the interest rate structure, and he also created this FCNR pool. And at that time, it worked because US interest rates were close to 0%. India's interest rates were, as I was telling you, 12% overnight and all that stuff. So the gap was wide enough that if you provided a dollar hedge from the RBI at a defined rate for 3 years, then Indian banks could offer foreign currency hedged exposure to deposits at say 8% or 7.5% or 8% effective rates. Well, for them, I think for the dollar rate, it was effectively 6.5% or 6%. But getting 6.5% in almost quasi-guaranteed dollar terms.
When you got 0.25% in the US, I can see why that worked and why it won't work now.
Yeah. So at that time, of course, the numbers were smaller. I mean, we are talking about it brought in maybe 20 billion or 30 billion.
And that was enough.
That was enough. It's just that India's economy is much bigger now, right? So but that's what.
But so 2013, how long did that last?
That was about between June and November.
Almost half a year.
Unexplainably, markets started to go up in December, and things were as bad. And according to me, it was like, oh, the dollar's still heavy, and I mean, it was getting better. It had come from 68 to maybe 63, and I was like, okay, this also sounds too high. It was a miserable stretch for a lot of people. And then I was looking at the markets, and the markets started to go up, and I was constant. Now, by this time, I've seen a few, and then I'm like looking at this and saying, peak pessimism is not a good idea. And at that time, I was just starting to think about building Capital Mind, right? So I could actually say that, oh, well, you know what, this is quite interesting. And there is perhaps something that we can do. I actually started building out the portfolio concept, investment concept in the mid caps, or thought processes around them. And we could see a lot of the ground data was actually starting to emerge in a better way. The point here was it was peak pessimism at that point. And in the time of peak pessimism, I could see markets going up, which.
And so this time you didn't disbelieve it.
I didn't disbelieve it. I was like, okay, this is interesting, because if markets are going up when they're climbing a wall of worry, if you may, that's, so there was some kind of pessimism overload, even in the news, even in the narratives, all the way till 2014 when the market hit a new all-time high, and then it's kind of kept going from there. 2020, I think the world was in a crisis,
so
right?
we weren't unique in that sense.
We weren't unique in that sense, but then when the world was in a crisis, they said India did worse than everybody else. There was this article by
a famous commentator on why I'm losing hope on India.
Why I'm bullish. I no longer have any hope for India. This was November 2020. November 2020, India had cases, but not meaningful amounts of deaths in that sense. And the bigger crisis came in 2021 for us.
The Delta wave.
Delta wave. But through the Delta wave, the markets actually went up. And when we didn't have as much, markets were going down, right? So the bad news was on the ground, but the economic data was showing otherwise, and the core data was showing otherwise. The stock markets were going up. So interestingly, when you got this peak pessimism case, was usually when the best. So there are certain commentators that if they start getting headlines, I look at it from a perspective of
the negative of the Forbes cover.
Right? So it's like, oh, this is correct. So it's like if everybody says India is bad, that's when my trigger thinks, okay, we're getting somewhere here. And people, I don't blame the commentators. There are the same commentators who were there in 2002 and 2009, early 2009, 2013, who would come on the forefront and be interviewed on TV channels and all that stuff saying, we want your views. Because otherwise their views were useless. When the markets were going up and doing very well, they would continue to be bearish. And then you'd be like, these people are a waste to listen to, because I can't gain 100% and lose 30% from that 100%. And then this person keeps telling me that this country is,
doomed. Yeah.
So I would say it's a sign. It's a trigger sign that says the narrative is worsening. So now it's time to check the data. It's happened in 2020, it's happened in 2022. In 2022, India was the opposite. We were doing well, economically as well, when the world was reeling under the Ukraine war's influence. Now, remember, crude at that time went the same way. It went to $130 a barrel. And yet...
We're not there yet, actually. Yeah.
We went to 100 when we've come back.
Well, right now we're not.
We're not there yet. When we saw all of this happening, and now where are we? We're again in a pessimism saying all of this stuff.
I'll interject over here that, I really felt this acutely because, as you know, I've been very focused on foreign and global investing myself personally for a long time. But in August 2024, I had held a small token position of, not that token, it's a reasonably sized position of NASDAQ 100 ETF through the Motilal Oswal product for the longest time. At that point, I think it was in maybe August, where there was some yen carry trade fears and everything had fallen quite dramatically for a month, and then it sort of recovered. I remember always being just ashamed of how badly that small position was doing compared to everyone else in India. And literally out of, I would say, guilt/shame, I just quietly exited saying, man, this has been a terrible 4 or 5 year experiment. I really need to let this go. That really was the bottom of that. So
it's like the peak pessimism in the US at that time, right?
Or the global exposure.
Or global exposure at that time. So interestingly, it's at the opposite end of the spectrum right now. It says that it's NASDAQ or nothing, and we are the nothing. And we are the nothing when you can buy anything else, but you don't buy India. So in that sense, there is this peak feeling that is happening. But I want to go one step further, and I would say, listen, at each of those times, the data was actually looking positive. The stock markets were started to go up, and what's the equivalent now?
Yeah, so I think let me bring that to the next phase of this. I get it, but why do you feel we're at the peak or the worst moment right
Obviously.
now? Because all the other signals you're seeing, are you able to see some of them now? And we will hold you to this. So this will either make you famous or infamous depending on how the next few months go.
Yeah,
or the year
look,
goes.
all of this is at some point speculation in that sense, right? But if I look at the trajectory of crude, I'm like, okay, where are we? We went to 120 or something. Where today, this is May 29th, 2026. It's at $90, a little bit less than $90 in the market today. The rupee has come back to some 95 odd levels from the 97 levels that it reached. Crude oil is primarily centered around supply. So there's a lot of supply that has been blocked because of the Hormuz crisis, Iran, Israel and US war. And that crisis looks like people don't want to deal with it anymore. Most importantly, last few days, if you see the US bond yields, which had gone, 30-year bond yields has gone to 5.2%. And
10 year was
4.6 or at some point, right? This is crazy for the US because every 0.5% increase in that 10-year yield is a $200 billion extra expenditure for the US.
That sounds absurd, but luckily the US can just print money, so none of this matters anyway. So yeah,
currently they don't want to because there's also inflation. They can print money when there's no inflation, but I think the Fed is also like, dude, if there's inflation, I'm not printing. So
are you saying not everything is perfect in the US right now? Is that what you're trying to say? Yeah.
We can talk about that separately, but there are issues where I think macroeconomically they've had issues for a long time. And again, all these issues I talk about India, all the peak pessimism concepts are not new to India. We've had issues like this in the past. We've had a lot of these issues. It's just that they're coming together in some kind of a nicely stringed, unified way, which one complicates the other and complicates the other.
When it rains, it pours kind of situation.
When it rains, it pours kind of situation. But because it is a linked thing, the important thing is look at the data. Okay, the crude oil reversal has happened. The rupee reversal is happening it's happening in a very slow way. But what's happening over there is crude itself is one part, right? So what do we do with crude? We don't want another crisis. We've seen this. Both the government and the private sector are like, we need to change our dependence because I can't have shortages. So what are they doing? There's some discovery of crude that they're talking about. They're talking about building more exploration. India does have a lot of crude oil that has to be explored. Now, it does cost money to explore this. At $60, it may not make a lot of sense. So at some point, the government has to say, listen, I will pay for some part of this. So you don't feel the damage if crude goes back to 60. But I want to buy that $60 oil from Indians rather than from the Middle East and from other places. So that's going to happen. At the same time, private sector is like, listen, we got to expand beyond this. So our energy requirements, wherever they're linked to crude, we want to de-link. Maybe go to coal, which India has. Maybe go to EV or electric batteries and storage, which I think India is working very strongly on. And that battery infrastructure with PLI2 and all that stuff will come back. So take a period of 3 years from now, our dependence on external crude will probably come down, not go up.
Or at least as a percentage.
As a percentage. Remember in 2008, crude went to $140 in 2008. India had to increase our interest rates by 1 percentage point at one point because we thought inflation will be so high. We were hugely dependent on crude in the sense that it was a much larger portion of our GDP than it is today. And therefore, we suffered for a while. But today, that crude oil differential is not as bad. Even then, they were administered prices. Now also the prices were controlled for petrol and diesel. But they've increased the prices of petrol and diesel to some extent. And that's going to cause some kind of inflation in the going ahead. But some of the crude oil pressures were about whether the government has to take a big hit. They have to take a little bit of a lesser hit now that the prices of petrol have gone up. But remember, they've gone up for the first time in 5 years. Which means if you increase the prices by 10%, but you increase it over a 5-year period, after 5 years, that means actually 2% per year, which is more reasonable for me to understand and take. But since it's a 5% at one point or 10% at one point, I just feel more pain right now. This pain doesn't extend to a 3-year forward phenomenon where most likely crude will come back. The situation at Hormuz, like I said, with the US interest rates, has caused the US to back off a little bit and has caused Israel and Iran to kind of come to an understanding that this war has to find an end. And I think if it finds an end, a lot of the supply shortages, a lot of the damage to prices, the prices that were going up too much, will come down and will get addressed. This changes the narrative on crude immediately.
Fair. But that's just crude. That was just one of like 5 factors, right?
So let's say gold. Now, gold, there's already been an appeal by the Prime Minister to say, don't buy gold. I don't think that's going to happen.
But it didn't seem to work. Like unlike some of his past appeals, this one didn't land really.
Yeah, it doesn't. It's not easy to tell Indians not to buy gold, but it's actually possible for people to monetize part of their gold holdings. I mean, I could buy a lot of gold because I feel richer or I want to use it, right? But if I'm the user of gold, there will be parts of gold that I don't use quite as much. Now, a lot of people do physically take their gold, exchange it and get new ornaments made. Typically, they lose 20 to 30% in that exercise. So there is a problem with gold that India desires to use it, but India has 30,000 tons of gold. We import 800 tons of gold every year. Now, 800 tons is a lot of gold to import because 800 tons adds up to about, I don't know, I think it's about a 72 billion or what, some number like that. A ton is about 1,600 crores. 1 ton of gold. So 800 tons of gold will be 14 lakh crores. That's a lot of gold. That's a lot of gold to pay for imports. But then there are 2 things here, or 3 actually. Let's look at the numbers. India has imports 800 tons of gold a year, but it has 30,000 tons. This is more than I think the next 5 countries put together or something. Some crazy amount like that, right? So there is 30,000 tons of gold internally. There is a potential way to get India to recycle 2 or 3% of its gold in the coming years internally. But more importantly, even digital gold and ETFs, they also import gold from outside and store it in their vaults. They are not allowed to lend it out for whatever reason. Now, I would say this part can be fixed.
So oil and gold, I think those were fairly persuasive. In a sense, almost desperate times will call for desperate measures, and this is something we can fix. But now let's talk about Indian industry. It feels like we're sort of in the industries of the past. And do you see that? Do you see that in maybe our profit growth or I mean, maybe now moving this also a little bit towards markets as well. When you look at our companies, do you feel we're basically behind the times and all innovation is happening worldwide and we're stuck with industries of the past? Or do you see our companies continuing to do well in some ways at least and some of those results percolating into the stock market?
Super. Okay, this is where forget the crude and gold. We can't have any major import on that. I mean, we control on that as us as industry. As industry, are we doing well? The answer to some part of it is there's some earnings growth visibility. December quarter was already showing those signs. The March quarter is showing amazing signs. We're looking at the Nifty 500 results far.
You could have fooled me because I don't feel it. But
I mean, it doesn't feel like it, but it's interesting that the median profit growth on Nifty 500 is like 17%.
That's quite high, actually.
That's ridiculous. I mean, some part of it may be a base effect and all that stuff, but it is very high compared to what it was in the past. The commentary that's come in is demand is there. Supply, there are some issues here and there, but they will get resolved. Almost every industrial seems to be doing well, really well. They're seeing an increase in orders and so on. The government itself has, after 2022, changed its mind about Indian dependence on foreign imports of goods, normal goods. Now, when it says mobiles and semiconductors and electric vehicles, batteries and cells and technology and so on, India has now started the effort of saying, listen, we need to reduce this. We need to substitute imports by manufacturing domestically. So I want to promote the manufacture of stuff domestically. What have we done this in? We have done this in cars, and we have become reasonably good now. Some of our cars are actually quite good, domestically manufactured cars. We are one of the few countries in the world to actually have a decent car industry.
Most people have just given up to China.
They've given up to China, Korea,
Used
Europe
to be Japan.
and US. Yeah. Even the US has given up for the most part, except in the US you find those cars a lot more than anywhere else. But the same thing with India. Indian cars are very popular in India, and we promoted that industry, and it's taken us a long time, but it's kind of come through. We have to think like that going forward, even for all the other industries. We need rare earths. India has a lot of rare earths. We don't have the mining and refining technology. We need to get it, or we need to build it. We need to build the research. We need to do the work. We need to refine this stuff ourselves. Like the Vedanta chief said, give it to people who want to do it. They will find a way to do it. We don't make semiconductors. We've started to make semiconductors, and it's already come from the low end to the mid end. That means we're working with companies like ASML to say, give us the machines, we'll do it. They might give us lower end machines, but at least if we were to manufacture lower end semiconductors, we could replace a lot of imports that come into the cars, that semiconductors are manufactured in China. There is a lot of work that's happening around this front, but the core data shows positive growth, not negative. In fact, solid.
But is it just profits, which could be like perhaps, as you said, base effect or something like that? What do you see in terms of, I don't know, capex or in terms of credit growth? How are those going?
Yes, so capex and credit growth are linked, right? So industry in India didn't do capex at all since between 2014 and 2025.
Why?
Because actually started off because of the Indian bankruptcy code. Now, the typical idea in India was large industrial families would take loans from banks and then default on them, then go to the bank and say, let's do settlement, DRT, etc., etc. The bank would take the hit and give another loan to the company to pay back half of its earlier loan, write off the other half, and then move on. This is very standard. By the way, this is also how a lot of farmer loans operate. When farmers realize there's a farm loan waiver coming, everybody stops paying their loans so that they can settle and the government will pay their loans instead. And then they get more loans and move on.
Okay. But you feel differently when the farmers do it and when some large industrial group does it.
This is a problem, right? So because we just feel that rich industries shouldn't do it, poor farmers, who are actually, some of them are quite rich, do it, it's fine. But I'm not going to get political about this. I'm just saying that this was the phenomenon done earlier. However, with the Bankruptcy Act, what started to happen, and it happened perhaps with, I think, Tata Steel first acquiring
one of those Bhushan entities.
Bhushan Steel, yeah, I think. And Bhushan comes from again a rich industrial family where they didn't think that this would actually go through, but the bankruptcy said, yes, you can repay only half of your loan. That's fine, but you lose the company. We're going to sell it to somebody else.
And it actually happened.
And it actually happened.
But this should have been bullish for capex?
So it was bearish because suddenly all companies which had borrowed and they expected to get a little bit of these write-offs suddenly said, dude, just pay back the loan. These banks will come and take over our companies.
So it was like a reset.
It was a reset. So they said, we won't do capex. And a lot of this capex was gold-plated. So in the sense of, if I wanted 100 crores, I'll borrow 200. I'll only spend 100. I'll siphon off the remaining 100. And, I'll make the bank write it off. So the real capex I'll pay, the remaining this thing. And banks themselves were very aware that this was happening. They would do stunts to kind of,
They all had some understanding.
There was an understanding. All of this stuff went away. Banks were loath to lend to capex in the first place. Corporates that were good were saying, I'm not doing any more capex. I'm done. I want to be zero debt. I want to be this. I want to be... Even the good... I mean, I'm not saying there are some bad corporates, some good corporates. The bad corporates were like, listen, we don't want to do this anymore. I don't want to lose the company for the sake of a few
But what about
crores.
corporates who aren't going to default on this anyway?
Yeah, they were like, listen, if you go to the banks, they are going to lump us in with the bad guys anyway.
So it was just an air of mistrust? Or in a new environment?
And people are like, listen, the IBC thing can be hurtful because anyone can put a claim anytime and then they could take your company through bankruptcy. It took a lot of time for the law to get established saying, listen, frivolous. But capex by itself did not go up across the industry. What is one company's capex was another company's drop in capex and so on. It is now, suddenly, that capex seems to have risen quite dramatically. It may be linked to the other changes we're talking about where the government is pushing people to do PLI, data centers are appearing in India and so on. All of these things have changed the nature of capex completely. India's got a nuclear breakthrough. That breakthrough is going to require us to build at least maybe 5 or 6 more nuclear plants, nuclear size things in the next few years. That has increased capex in one area. There is semiconductors, there is differentiation in cars. A lot of this is for domestic usage. I'm not even saying for export. Just replace domestic usage and you should be in better shape. All of this is happening at the same time. And how does it reflect in data? You look at bank credit growth to industry. It was at 15% in 2013. It grew 15% year on year as measured in 2013. It went to 0% even negative after that. That means it kept going down in terms of growth. And then Now it has finally come back to 16% as of March 2026. So capex growth is increasing, and therefore credit growth is increasing because people are funding this capex through credit, bank credit. And because you can see it in industrials, I think that is one very important sign. Even the personal loan credit, that means you and me taking loans for housing or for personal loans or for businesses or for a loan against securities and all of that stuff, even that is growing now finally after 2 years after RBI clamped down on the sector quite strongly in 2024. And then for a year, we saw credit growth, even in the personal area, for personal loans go to zero. And then because there haven't been that many defaults, RBI has eased up on this. And then now we're back up to 16% there as well. So if you consider credit as one early stage indicator of India showing signs of recovery, then credit is coming back.
So both capex and credit, you have enough positive narratives to indicate that things are, in a sense, turning around, and it's already happened. We just don't believe it yet. Now, maybe I thought I'd bring this, unless there's anything else that I've been forgetting, I thought I'd try and bring this to investors, because so far, we've been talking macro. There's oil, there's gold, there's credit growth, and so on. But most of us, especially the people listening to this podcast, while this is all very interesting and useful, the fact is we look at stocks, or we look at mutual funds, or maybe we look at some debt funds or something like that. And over there, we've been in a couple of years of, I think, at best flat to low single-digit returns, and at worst, if you've been in the wrong strategy, negative 10, negative 20, who knows how bad it could have gone depending on where you were stuck. So on that, do you even see some beginnings of green shoots in the stock market?
Yes.
Like remember all those other episodes where it has started to go up, but everyone's like, oh, don't take this seriously.
Yes, I know. It's interesting. Let me take two areas where I think India has gotten a beating. One is the FPI/FDI issues, and one is the AI kind of issue. With AI, they said, okay, let's start with AI. I don't want to dwell too much on it. There are too many people writing so many things.
I don't think I could stand to listen to another take on AI.
Every morning you come, and today I hear that the AI tools that people are using are suddenly refusing to do work. Because they're training, they've been trained to say, I'm sorry, you're not supposed to write this email. I'm like, dude, if I wanted people to, I have enough.
But I'm starting to mute this on all my data. But
yes.
anyway, leaving aside
AI is not the AI, but the AI's problem with AI was A, India didn't have much AI.
Yeah.
And B, India was going to lose jobs to AI. I think both of these assumptions are just wrong. Every technology takes away some jobs, creates 10x more. Whether it was the typewriter industry that would have been destroyed by computers. Yes, sure, you sold some lesser typewriters, but you got people who could type, continue to type on a different framework, something, a different skill. But when you had an STD booth for mobile phones, people got wiped out, the people who owned STD booths. But now they sell some other stuff while people use mobile phones for everything. You can't pay someone to make a phone call anymore.
But now I really need you to bring this back to markets. Because I'm getting.
So what happens over here is that if you think of AI as not having a negative on it, and there is a positivity to maybe more work coming along, the fear on this IT companies destroying themselves because of AI is no longer valid or isn't valid in the long term. That has one thing. Second, our FMCG companies got hit because they said AI is going to reduce jobs. So, well, you know what? That impact is not there. So I'm saying downstream, if you look at the AI part of it, second order effects, it's not as bad as it was. Intel too, as we've seen. But at some point, there will be the next gen of players that will sit on AI, many of whom may be in India just because India has the enterprise to build those companies. A lot of companies in India are doing routing for AI and a bunch of security features and all that stuff. But there's also a lot of next-end companies that are being built here that may take place in the next 5 or 6 years. So I don't think we will lose out on the AI game. From the listed market, these guys may still take some time, but you will find that there will be usage-based parameters on top. Now the markets itself, if they've taken these negatives and the FPIs have taken these negatives and suddenly find that the narrative that India is 0 on AI is maybe 2 on AI out of 10. That itself brings in some investment going forward. But there's a peculiar concept in FDI as well. FDI is essentially what foreign investors have invested in unlisted companies. So Swiggy, Zomato, etc. When they were fledgling companies, got investments from abroad, those companies have listed. Now these are VCs. The VC structure says you don't get to behave like a fund that can repeat its investments. That means if you sell something, you have to give the money back to the investor. You make your 20 investments, whatever makes money, take the money out, give it back to the investor. He gives you new money, you create a new fund, and you go on.
Well, it generally takes long enough anyway, so thank God.
Yeah, that's the way they have structured. But it's not like us as a mutual fund. If I sell one stock, I can use the money and buy another stock,
correct.
and that's perfectly fine. I don't have to return the money to the investor itself, right? So when these companies list, so whether it is a small company or a big company, when they list in the market, these VCs have to go to the market and say, whatever money, whatever I can take out, let me take out. I have to give it back to my investors. My investors then have a timed phase lag between them investing into back that money into India. Maybe there's a negative sentiment right now and so on. There's also the fact that interest rates are high in the US, which means that people who are investing in fixed income can make a slightly higher return. So to that extent, I think there is some pension funds and all that who said, take out our riskiest investments and invest them back into fixed income because I don't need the extremely high returns from emerging markets. I can use them in US government bonds instead. So they've changed the mix somewhat. But I think all of this is going to reverse, and this will take longer from an interest rate perspective. But I think overall you'll see that as time goes by, these FPI reversals in terms of bringing back that investment and reinvesting into India will happen over a course of time, especially after if there is a, I won't say AI bubble burst, but I will just say slowdown of growth in the AI infrastructure that is currently being done in abroad. So I think some of that money will get reallocated. So markets then benefit from liquidity that says the foreign investors don't go out as much. Rupee benefits in some way because again of these reversals. The market is already showing signs of earnings, and then we're seeing an increase in domestic investment, domestic industrialization, and so on. So there's a downstream impact. Now, don't think of any of this as this is May, this will happen in June. I think you should think of 2026 versus 2030. How do we go from here to there? I think that is the thing, that picture that we're missing. It was peak optimism 2 years ago. There was nothing but India.
You were India plus China plus one,
China
Goldilocks
plus one,
economy.
Yeah, China plus two also, if in some cases. Goldilocks economy. The words were, flowing out at that time. And like you said, in October 2024, the US was underperforming India by a large extent. So to that extent, it sounded like India was the best thing to be and nowhere else was the best thing to be or a good thing to be. Now the tables have turned. Korea's PE of 4 has gone to PE of 8 and they've doubled, and Taiwan has gone up, and Japan has gone up. Suddenly you find that there's everything but India. I think both these views are wrong. The truth is always somewhere in between. So it makes sense to invest into Indian markets during a period of pessimism, understanding that all of these stuff I talked about will take you another year. But over a 4-year period or 5-year period, you're probably going to see the benefits of whatever is we're doing to fix what's happening right now.
Okay. It's like, as Ruchir Sharma says every time he comes on a stage, India manages to disappoint both the optimists and the pessimists at all times. So that's completely understood and taken. I have 2 areas I'd like to stay at, and maybe I'll move on to advice for people as they're looking to invest. The first one, Deepak, is, a lot of people from India have in this time been talking about the importance of foreign investments. They've set up either they have something in Gift City, or they're saying, no, I don't have anything, but you should still do this. I can maybe give you advice, or I can give you some ideas of what to buy. It's done well so far. I'll go as far as to say that, even last night, I had to wake up, and this morning I was like, is this a typo? But apparently Dell is up 40% after hours, after already being up some 100% in the last year. So the momentum there hasn't abated there yet, if I may put it that way. So how do you feel about people who are like, look, this was a wake-up call. I can't have all my money in India. I should have money abroad, and these noble souls are helping me with my journey abroad, whoever they might be on Twitter or things. Let me go and listen to them and hopefully invest some money abroad. How is that going to go?
No, this is actually, I think, also recommend. We've been talking about this since 2016, 2017, where we said so many of our investments or our investors themselves should have some kind of foreign exposure. We've had the Nasdaq 100 ETF, even the PMS for a while. We've actually done, talked to our customers and said, 5 or 10% of your investment should be non-India. One of the reasons why it should be non-India is just for the diversification and the fact that you might need dollars when, let's say, your kids grow up and maybe they go to a college abroad and so on. However, it's overdoing it to a point where, I should take all my money out of India. I should take a significant chunk of my money out of India. I should then, if I take 10% out of India, then 90% is India. If India hurts, my 90% of me hurts. But I can if I go around telling everybody my 10% is doing great, that part is also incongruous by saying that's the only thing that I have, right?
It's like when you only look at the one profitable stock, otherwise bad portfolio.
Yes, it doesn't really. But I think you should have a diversified portfolio for this precise point that at some point you'll have a mix. There are some issues here that, there is an LRS limit and, those limits may change. There is a taxation on every LRS thing that you do that has this
the
thing.
TCS, yes.
But you invest out when the dollar is at 95 and your investment abroad is exactly the same. And the rupee comes back
to say 85 or something.
85. So because rupee is,
or 90,
so there is a measure called the REER. I don't believe in it because I think it undervalues the rupee. But because the complexity in this is REER is a merchandise trade weighted average of all our all trade between different currencies, countries, and our relative inflation with those countries. Now, when you do merchandise trade, we have heavily weighted on China. We have some US, but China is our biggest. So our relative inflation with China determines where our thing is, and China is a controlled, exchange rate economy. However, India has a significantly higher services trade with the US. So if we use that, India's relative inflation with the US is much lower. In fact, India's inflation is in fact lower than the US right now. So technically we should be appreciating if you looked at just inflation. But I'm just saying that this REER undervalues the rupee. The REER was 105, 106, which to me was not a problem. But today the REER itself is at 90. And that also, according to me, undervalues the rupee. So
that itself says that we are 10% below
yes.
what it should be.
So it could go from 96 to 87. Just
if you get that right, we're going to air this segment again.
No, but then it takes sometimes it takes a year. These are macro, paint dry, watching, and all that stuff. But I feel if that happens, you lose 10% in rupee terms. You'll be the same in dollar terms, but if you'll be 10% down in rupee terms, and that is a 10% loss, that's one whammy. Right?
Which is, right now you're having the opposite. If you had any dollars abroad, you're seeing it, the rupee value go up, partly because of the currency.
Second thing is, what if there is a return of that peak pessimism thing happens, where India goes up relatively more, because it's at a relatively lower number, and we are in the early stages of where we are. But if the recovery is fast in the next 1 year or 2 years, you might find that the Indian change in stock prices could be higher than what is happening abroad. The second one is, let's say the B part of this thing would be, what if the US markets or the world markets don't return as much? There are lots of reasons why, and macroeconomically you could argue either ways. But there are lots of things like US bond yields being very high, has a deficit. All of these countries have deficit issues.
Infinite money printing machine might one day face constraints.
Might be finite, yes.
All right, Deepak, here's my closing question. Let's say someone has made it through to the end of this podcast, they've listened to it. At some level, this is also very prescriptive, how things we can do. Now let's look at, again, your own portfolio. There are a lot of people, I know customers in our PMS, and maybe I guess to some extent customers of our mutual fund as well, who have cash on the sidelines, who got it over the last years, have saved it and haven't deployed it yet. Is now a good time for them to deploy? Should they do equities? Should they do Indian debt? In equities, should they do small cap, mid cap, large cap? How would you ask them to think about this to the extent when they're making their further decisions of, I think this has further to go? Or if someone right now is thinking, maybe I should do some LRS, how should they think about this?
Yeah, the LRS thing is a question that I think everybody will have at some point. But I say, think about it as a systematic investment rather than a lump sum. You can do this over a period of time, but That 10-20% of portfolio is where I would say do it, because there are complexities in investing abroad, tax differentials, all sorts of things that happen. But at the same time, I think now when you have a lot of cash, your portfolio is, let's say, 50 rupees investment, 50 rupees cash, or say 75 rupees investment, 25 rupees cash. That 75 rupees, let's say all of it was in equity, or rather half of it was in equity. You wanted yourself to have a 50-50 exposure. You now have 37 odd in equity, 37 odd in debt, and 25 in cash.
That's a lot of debt in
That's
this
a lot
example.
of debt. Yes. So, I mean, assuming that 50-50 is where it is. But if you just want to bring back yourself to 50%, you would actually have to invest half of this money again into equity, half of this money again into debt. But let's say you decided to invest a certain amount, I don't know, it's maybe 10 lakh rupees that you've saved. You want to invest it in equity to get your equity net allocation to some level. That 10 lakhs should not go in at one point, because we know all of these problems that we just mentioned are not going away tomorrow. This is not the bottom. This is peak pessimism, but it may not be bottom. The peak pessimism phase can last 3 or 4 months. Narratives can get worse. These particular commentators can be on the front page of
everything.
Newspapers. There is a lot more that can happen, and we've seen that optimism can also go to crazy extremes. We saw in the US that at some point the market actually nearly doubled before it fell.
In the 99
situation, because people kept saying that the market will go down, and the market doubled before it fell. So the unfortunate part about not being able to predict those markets.
You can't time it to perfection.
Yes. So I would say, therefore, I don't have a correct answer on now, tomorrow, later. I just say keep at it. Things could get worse, but I see the next 4 years as very big positives. So regardless of when you invest now, I think 4 years later, returns should be commensurate to the greater economic growth that we will see. So you'll be fine over the period of time. The reason I'm saying that invest in a phased manner is because I said peak pessimism when market prices were going up. Market prices are not yet going up.
But they're not going down.
They're not going down.
Yeah.
But I'll give you that. But they're starting. They're showing signs. They're saying, okay, maybe, oh no. Maybe, oh no. So that's what they're doing right now.
So we're testing the bottom.
There will be a point when the market hits a new all-time high. And it will seem at that time that, come on, how can our markets be hitting an all-time high when
this will just collapse the next week?
Yeah. This is another big trigger. This is my last trigger, at which point I say that at that point, I'm confident that things will go back in the long term. And I feel that, even at that time, it's like a phased investment. By the way, we did hit close to an all-time high in January this year. And then we got the Iran war in February.
And so we're back down.
And we're back down. If we hit it again, and I think that's when I'll get more confidence that this is actually peak pessimism at a time when market prices are going up. So since that is ahead of us, that's why I say invest in phases. I think that when that does come, then you'll get yourself use it as a trigger point to say, I'm on the right track. At least I've invested in the right track. I would say that is the point that you want to play. The type of fund, large, mid, small, multi-cap.
Is there any pattern from previous crises or something special this time because of the level of, capex or something we've had?
So I think capex means typically that the largest companies will do better, but it also means that the absolute number is better. That doesn't mean that the smaller companies will grow at a smaller percentage rate. So it's like if a 10 crore company doubles, it becomes 20 crores. If a 100 crore company grows at 30%, it's at 130 crores. So the 30 crore differential is much larger than the 10 crore differential of the small company. But you've got 100% return in one versus a 30% return in the other, right? So the percentage gain could be greater if you invest in a more diversified portfolio that contains both large, mid and small. If you don't know,
do flexi caps or do all of them?
Yeah, we have flexi. So I mean, in that sense, we do have offerings.
Make this your fund manager's problem, not your problem.
Fund manager's problem. And then, if you don't even know whether to invest in equity, debt, or commodities, then go to a multi-asset or spread your wings that way. I would say the actual instrument to invest in should be as broadly diversified as possible. If in the equity universe, then the flexi cap is the most diversified. If it's across the market, a multi-asset makes more sense. But that is your typical, I don't want to have to think before I invest thing. I wish Indian mutual funds could invest abroad much more easily than we could give international diversification, but there are limits right now. So those investments you may have to do personally on a separate basis, but understand that you have this 3 or 4 things that can provide that whammy that takes away from your returns in the next 3-4 years. But that's fine because you've gone in there for diversification.
All right, fair. All right, Deepak, so I'm curious to see how this episode ages, whether we really did catch the worst of peak pessimism or if the worst is ahead of us. So we're going to find out soon enough, and we'll hold you to it. All right. Thank you. Well, that's our show. I think, like me, you're probably curious to see whether we've timed this one right. Is this truly the moment of peak pessimism and things are going to turn around, or is the worst still yet to come? But either way, if you're looking at your Indian investments more seriously and are figuring whether you'd like to add more to it, then I think there's 2 ways we can help you. If you have more than 50 lakhs and are looking to invest, we have our PMS, capitalmindwealth.com, where we can invest your money in Indian and eventually global stocks and securities. And we have our mutual fund. So if you'd like to get into our FlexiCap fund, our multi-asset fund, and maybe outsource the decision making and even the taxes to someone else, then you can go to capitalmindmf.com and take advantage of a much smaller ticket size to participate. So with that, see you next time and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.